Good morning or good afternoon. Excited that it is now March. Year's flying along, March 9th. Thank you all for joining us today. We're here for our ALM 101 presentation. Again, good morning on the West Coast, good afternoon on the East Coast. We're excited to have everyone here. And today is going to be a neat time to talk about ALM 101, learning about ALM, talking about what ALM means. A lot of stuff going on in the ALM world right now with rates changes and different viewpoints on the economy. As we go through our presentation today, if you have any questions, please feel free to click on the Q&A button, and we'll be answering those questions throughout the presentation or at the end, whatever is appropriate. And our presentation today is being recorded, and it will be available on our YouTube channel. Please reach out to your advisor, your MFA, McQueen Financial Advisors advisor, and they'll happily send it off to you. So as we kick stuff off, I'm Charlie McQueen, President of McQueen Financial Advisors. Really excited. We've got some great people we work with. I have our Asset Liability Management team, which Heather here leads. We're excited, and we're going to talk about ALM. We also have our Investment Advisory Division and our Valuation team. So three great groups that are tackling all sorts of things. And we've also have CECL going this year, which is really darn exciting as that comes into requirement on January 1. With that, joining me and the leader of this presentation is Heather Shepperly. Heather is responsible for all things ALM, kind of like the sound of that. And Heather runs our ALM division with an incredible group of people, advisors, analysts. They take everything from data to a finalization of a report and simulations and many different areas. Really, a really skilled team that she works with, and we're excited to have Heather here and talk about all the fun things that ALM 101 is all about. Thank you for joining us, Heather.
Thanks for having me. Thank you very much. And thanks everybody for joining us. Looking forward to it.
Yeah, this is going to be fun. We're going to kick off today with a little bit of an economic update, and we're talking about what is ALM, and we're going to talk about modeling reports, ALM analysis, and a summary at the end. Really exciting here. And I think, well, why are we going to talk about economics? Well, you know, besides I'm a closet economist, I've been told a few times. Economics and interest rate predictions is extremely important. ALM is all about ensuring your balance sheet performs well in all interest rate environments. And it's about not making bets. It's about planning. It's about execution and structure of your balance sheet. And so that's what we're here to talk about. And you know, as we kick off, I'm going to go through a little bit of an economic update. And the economic update today starts off with one of the most exciting things. You know, my quality of movies I watch here. With the boo from home, rising interest rates, yay, it's the best day ever. And we're really excited about this. And why are we excited about this? Well, we're excited about this because as interest rates rise, we're going to see positive impact to earnings. We're going to see our margins go up. If we look at this, these charts, one is for institutions above $1 billion in blue, under $1 billion in the kind of gold color here. Margins are at all-time lows today, and we're going to see them come up, and most of our income comes from margins. And so as we look at this yield curve today, it's all about thinking about the structure of your balance sheet. It's all about thinking about managing risk. ALM is not about removing risk. ALM is about managing risk and having good earnings in all interest rate environments. It's not about taking bets. We have people that we know that have made bets that they believe that interest rates are rising so much that they have a vast majority of their assets in cash. The yield curve is a great indicator of what's going to happen. Now, we do think rates are going to rise, and we'll talk a little bit about that, but rates have already risen quite a bit. And the shape of the yield curve is giving us some indication that rates maybe won't rise that high. If we look at this black dotted line goes back to December of 2012, and the red dotted line is today, technically yesterday or 2 days ago. And what we'll see here is that the big changes have really happened in the 1 year, 2 year, 3 year time frame. But once you make it out to 3 years, 164, you're only getting another, 9 basis points to go out to 10 years. Very, very flat yield curve after this immediate steep component. And that gives some insight that a lot of prognosticators on TV don't agree with, that maybe we don't see the Fed raise rates as high as what many people expect. One of my favorite charts, and to think about this from an ALM standpoint, it's really key to remember not all rates move in a parallel fashion. A lot of things we talk about in ALM is the parallel movement of interest rates, But we also do 6 different shifts and twists in our ALM reports, standard ALM reports every quarter. Why do we do that? Well, if you look at the shape of the yield curve, it doesn't change always in parallel function. Now here in 2016, when rates started to rise, we actually see that it does move in a parallel fashion. But once it gets to the high point, it didn't come down quite the same. But in these normal environments, we have a lot of movement that's not parallel. But we will see rates rise. We already are here, but we've seen a lot take place. The 2-year Treasury. Last time the 2-year Treasury went up as much as it did, the Fed had already gone up 75 basis points. So it's interesting to see here. It's not a bad day for reinvestment. We look at the Fed funds rate today. We've obviously flatlined since the beginning of the pandemic. But the futures right now are predicting that the Fed raises rates a number of times, basically 25 basis points at every meeting, except there's a little bit of potential here in September and November that they only raise one of those 2 meetings. But it's saying here we should expect, and this is the Fed funds futures again, which is the betting in the market, we should end up at about between 1.5% and 1.75% on the Fed funds rate, significantly higher than the 0 to 25 today. So we do think they're going to raise rates at March 16, 25 basis points, but we don't think they're going to be nearly as severe as what a lot of people have been predicting and talking about. This is really important for ALM. We want to make sure that we look good from an earnings and equity standpoint today as we are, and also if rates would go up in the future, like the Fed funds futures are projecting here, maybe 100, 150 basis points, but also we're going to want to say what happens if they go up 200, 250, or 300 basis points. We want to make sure that we perform well in all those environments, and that's what asset liability management is all about. So with that, we do have a bit of inflation, and for our economic update, we've talked quite a bit about this, our webinar a few months back. How do you get inflation? Well, you apply a lot of cash to things, and then you have a supply chain meltdown, and that's what we're in the midst of. And this war in Ukraine is not helping the supply chain side of things. It's actually causing fuel prices to rise quite a bit, on top of all the terrible humanitarian side of it. But from an economic standpoint, we are seeing oil prices rise and food prices are rising because of the amount of oil and food that's generated in that region. So we have seen inflation come up substantially. We do expect it should start to taper as the higher food prices and gas prices will actually start to have a negative impact on inflation as people are spending more money in those areas than others. It's a long time since we've been at this rate of inflation. The Fed's definitely in an interesting spot now where they do need to raise rates a little bit. They also need to cut back on their purchases of securities and continue to taper their holding of investments. But we got to go back to 82 since we had we had inflation this high. Hopefully here we begin to see the inflation calm down a little bit as logistics improve. And unfortunately, people are paying much more for food and energy, which reduces disposable income in other areas. If we look forward from here, a couple things we see happening. We continue to see a very tight labor market. Unemployment rates are back to record low levels. And we are seeing a number of actually women re-enter the workforce. That was one of the biggest drops in the participation rate. And we're continuing to see the participation rate trend up in the right direction, which is nice. A lot of what we learned through this pandemic here is that workers care more about flexibility than being remote. And it's good that people have the ability to have flexibility, work in offices, work remotely, but having that key flexibility for their requirements in life. One of the things that is worth update here is housing. This is something that affects our ALM report quite a bit. If we have huge refinance activities or good, strong housing demand, we're going to see more mortgages. We can get gain on sale of mortgages. We can also put mortgages as loans on our books. We do continue to see the housing market be strong. And the real reason here is a lot of people have been in their homes for a long time. They're thinking about moving. And at the same point, there is a lot of Gen Ys and millennials that are coming along that are in prime home buying age. And that's something that's really, really important. And we're going to see a lot of people. A demographer told me the other day he believes there's about 80 million Gen Ys that are going to be coming out looking to buy homes here in the next decade, which is really going to push the home buying activities even higher. With that, as I mentioned earlier, inflation with crude oil prices and gasoline prices here is very high. We've been up to about $130 a barrel of oil. Gas prices have definitely spiked up substantially from where we have been, and we're going to continue to see those higher with the conflict with Russia and Ukraine. Stock market's bounced along. It's going to make people think a little bit here. We went up a long ways. We've come down a little bit, but we've definitely went up a long ways. And so with that, I do think we are entering a time of a little more uncertainty, and we're going to see things be a little bit different, and that's going to cause people maybe to rethink things a little bit. And so as we think about interest rate risk management, we want to think about how consumers are going to act, where interest rates are going, and how that's going to impact us. And so what we see today is we're most likely going to continue to see a little bit of rising interest rates, and therefore we're going to want to look more at plus 100, plus 200 basis points in a gradual scenario as we get into ALM. So moving forward from here, I think as we've been talking about profitability for 2022 and beyond as our presentation topics for this year, margins will improve, and they are improving with interest rates coming up. Inflation will moderate. We definitely see that with some of these energy prices. Loan volumes can improve as people are borrowing more, and plus the free money has been cut off, and so deposit growth should slow. A lot less free money coming out of Washington. But at the same point, we are going to continue to see lower than average loan loss reserves. One thing to think about is CECL and CECL implementation. Sooner is better, because there's definitely going to be some interesting issues when it comes down to the dollar amount that people have in their loan loss reserve accounts compared to what the CECL numbers say. So with that, timing encourages us to do more, and to think about asset liability management today is really planning for the future. And so as we kick to the future here, we're going to talk and ask Heather, what is ALM? And as a quick reminder to a question, there will be slides available on our YouTube channel, or call your MFA advisor, and either way you can get them. So with that, Heather, what is ALM?
You, Charlie. So thank you everybody for joining us today as we dip our toe into ALM. And this entails us starting at ground zero. ALM can be pretty overwhelming. There's a lot of moving parts, and when we incorporate movements of the market, that really gives us a lot to talk about and discuss. And so what we're going to try to do today is simplify the complex. And when we need to start with basics, and these 101 series are designed as a great way for newcomers to understand the what, the why, and the how. So what is ALM? We have a couple textbook definitions here. And the first is the practice of managing risks that arise due to mismatches between assets and liabilities. And then we have a second statement here that refers to the technique companies employ in coordinating the management of assets and liabilities so that an adequate return may be earned. So what exactly does that mean? I don't think this really gives us a good, clear picture of what that is. So we're going to take today to kind of break this down and make this a little bit more easier to understand. So Charlie, when we go on to the next slide, and that is looking at our ALM, which is an acronym for Asset Liability Management. And as a team here, we generally refer to ALM as the teeter-totter. It is that balance of both sides of the balance sheet. And you can see this picture at the bottom, looking at this balance of the two sides. And this is really an art form. We joke often that we have a little bit of science, a little bit of art. We're going to see this a little later as we kind of break things down a little further. But this art is managing that mix of volume and interest rate sensitivity of our sources, which is all of our deposits coming in the door, our liabilities, our non-maturity deposits, term deposits, and borrowings, and then the uses of those funds for the purpose of controlling interest rate risk and providing a constant positive net interest margin. And when we take these deposits coming in on those liabilities and we feed them into the assets, we're using those for interest sensitive products, for risk management, or ALM, like we're talking today. And that's referring to our lending, investing, and then our overnight funds position, making sure we're putting that cash to work. So as we continue to break this down, I have a little bit better understanding of that balance of both sides.
Yeah, it's really interesting to me, Heather. I like how you've put this here with liabilities on one side and assets on the other. And the bottom of the teeter-totter, which means the lower cost, is going to be the liabilities. The higher end is going to be assets, which is going to give you that spread. And really what all this about, asset liability management is about, is managing that spread, ensuring you make money at all times. And then we'll get to the equity valuation too here, which is our other second big component. But really, really a great way of explaining this.
Yeah, it's really looking at that big picture, how everything's coming together and how it flows through, and making sure that we can balance here. And we're going to talk a lot about that today as we get through each step, of understanding where that balancing comes into play. So, just as a visual flow of funds of how this all works, is watching these deposits come in the door and then feeding into our assets and our lending and investing. And one of the biggest obstacles that we come into with asset liability management is knowing that we're not going to have a perfect match of both sides, which that gives us risk because we're not perfectly even no matter what things do, that nothing's going to change. We know there's going to be variations. We know that we can't match our terms perfectly or duration perfectly, which that could lead to problems for our financial institution. So we want to make sure we have the right amount of risk for our balance sheet. And that's what we're really going to focus on today is what are the right questions to ask? Where are our balance? What is appropriate for the structure of what we're looking at, what we're dealing with for our financial institution? It's really important to kind of see that visual and that understanding of how things are flowing through and finding that perfect balance.
Yeah, it is really ALM is balance and not making a bet in either direction, not taking too much of any one credit. Concentration risk really is born from ALM, and that's one of the key things of thinking about that. How do I make sure I balance out the risks that I'm taking, term, product type, all sorts of different ways.
So the next slide refers back to that art side. We joke often that ALM is a lot of art, not necessarily science. We do have some science that comes into play. And again, we'll talk about this in a little bit, but it's really looking at the structure of our balance sheet. And the unique part and the art part of this is every institution is different. Whether you are a school-based credit union or a commercial-based bank, as a financial institution, we have to do the right thing that's right for us. So whether that is understanding that appropriate mix and blend of our balance sheet is going to be correct for us, it's not necessarily going to be the right movement and the right mix for somebody else that is just down the road from us. So we want to make sure we understand our composition, our structure, and making sure that that risk position is appropriate for the structure of our balance sheet. And that's really the most important piece to understand is we can't look at another institution down the street from us and apply everything they're doing to ours, because that's not necessarily going to be the right approach.
Yeah, it is interesting. One of the things that I learned early on was different membership structures have different behaviors. We have a client that is a teacher-based credit union, another one that's a different credit-based and a different neighborhood, and the credits are different, the products are different. So it really is important to make sure you're thinking about the uniqueness of it. And so with that, Heather, why do we run ALM modeling reports?
Well, we run these reports because it is important for us to understand what our risk looks like. We know that for regulatory purposes, we're required to do this. Examiners want to see what our risk looks like, making sure it's appropriate for the structure of our balance sheet. And, we see many times that we want to check the box. We want to run this. We know we completed it. We set it in the drawer and wait for the next exam to come in to hand it off and say, yep, we did our job. We measured our risk. Here you go. But we really want to make sure we're doing is utilizing this output to make proper decisions. And so it's extremely important, not just for regulatory purposes, but also making sure that we're doing the right things for our institution to ensure that we have a proper risk measurement, we have maximize our profitability and do the right things for us.
Yeah, I really appreciate that, Heather, because what we're doing here is we're really we're running this to come up with a couple of things. One, we have a report so we understand this modeling, but that's really about managing then your balance sheet management. And that's something that our advisors do a great job of working with these incredible reports your team develops to then sit down and talk about it. What does it mean? How should we manage our balance sheet? And come up with actionable ideas to make sure that we're structured profitably for now and into the future. So really, really important component here.
So go ahead. So as we look ahead, and why we do this is we're going to start off with taking all of our financials and all of our interest sensitive products and look at where we are as of today. And this is what most financial results are really focusing on, or some historical information. And that's really that starting point for ALM. We have a little bit of the science part, which is that accounting, looking at every interest sensitive loan, investment, all of our deposits, our borrowings, anything that's tied to an interest rate, and making sure that we've captured all of those moving pieces and we're not forgetting something along the way. Because we then take that and apply it to the model to see, what is this looking like in the future if we continue to function the way that we have, and that goes on for the next 12 months. What does that risk position look like for us? And this is that, almost, you can see this report card listed on this page here. This is really trying to catch a problem before it happens. We can see this forward look of, as interest rates stay where they're at, and we look at this base case scenario, but also if rates start to change over time, what is going to be that impact to our balance sheet? We want to make sure we are structured in a manner where we can handle those movements of the market over time and be able to continue to sustain a healthy position. And this is a great way of seeing that forward projection of, as things continue to go on, that we're doing and implementing the right things for us. And this is a great way of being able to identify that early on.
Yeah, I really like what you say here. I see it just a little bit differently. I worry about things so they don't happen. And so if I worry about rates going up or rates going down or rates being the same, and I'm okay in all those scenarios, then I'm good. And it's that pre-planning that you do. It's taking the knowledge of your ALM report and applying what you learn, applying to make sure that you're diversified, applying to make sure that you're fully invested appropriately with the right term, making sure you're making all these difficult decisions along the way and actually following through. And that's something that we don't see a lot. But your next slide here, Heather, I love, because whenever we use the term crystal ball, I think we're betting on the Lions and how much they're going to lose by, but you have a different viewpoint here.
Slightly different viewpoint, yeah. So as we look at these forward scenarios, we really want to just understand exactly what our structure looks like. What is the worst case scenario for us? What are these line items that have the most type of impact? What adjustments can we make to manage that risk and to improve our profitability? And really, this bottom line is that impact to our capital position. Fortunately, this past couple of years have been very tough on our capital with the influx of deposits coming in the door. We've done a lot of things to be able to reapply those funds in the best way that we can. We had a lot of opportunities early on with mortgage refinancing. Well, there's some risk that comes to those long-term mortgages. Were there too many of those on our balance sheet? Did that add risk to my position? Was that largely impactful? But are we also putting that money to work to ensure that we are offsetting that squeeze to margin? Where do those opportunities lie? And that's what we're really trying to project in that future, is what can we do today to keep that capital in a good position despite all these other factors coming at us, and really being able to kind of look forward and move in that right direction.
Yeah, really, it's. I love this. We're envisioning what we think is going to happen. We're going to think about those activities. We're going to look into the future and come up with it. And there, with that, we need to look at these versions, activities, thoughts, and our actual balance sheet on a quarterly basis. So the question here is, why do we run ALM Quarterly? Is really an interesting one.
It is. For many years, we had a number of institutions that didn't necessarily run ALM Quarterly. And as we saw over these last couple of years, there are such shifts and movements in the market every day, and especially on a quarterly basis, that we're seeing the need and the request for these reports to be done on a more consistent basis. And that quarterly look at where we are in comparison to what the market is doing really helps us control that risk position, as things are changing all the time. And we want to make sure that we've got that balance of both our balance sheet and then capturing what the market is actually giving us as well. So depending on where those opportunities lie is where we need to constantly be reviewing and looking at where these where our risk currently is. Where do we have opportunities? Do we have opportunities for lending? If we can't fully deploy all these funds, what do we do in our investment portfolio, making sure that we are structured in a proper ladder? We're keeping those funds going to work and continuing to rotate through that ladder position and taking advantage of a little bit higher interest rates that we're seeing today versus what we were seeing, say, 6 months ago. So making sure all of these moving parts are continuously being monitored and watched and taking on those opportunities as they arise.
It is. We're going to talk a lot about all the assumptions we put in ALM, and some we get to choose, some we don't get to choose. And prepayment speeds of loans, for example, can change wildly with interest rates and the economy. And that is one of the things that can change values quite a bit. So it's important that we think about this on a quarterly basis. So with
Charlie,
that, yeah.
That's a fantastic point, especially with those prepays, because I think that's one of the main reasons why we saw some shifts and changes for how often we're looking at this, because they are changing so fast that we were seeing that our risk position is largely getting impacted by that slowing. So we really want to make sure that we're watching this every quarter as we're seeing that risk position change very fast, simply because of where the market is today, not necessarily every moving piece that's going on our balance sheet, but that impact that the market's having to our balance sheet as well.
Yeah. Thank you, Heather. So from why do we run modeling? It comes our next section is how do we perform this? How do we perform ALM analysis? And it's a fun thing. I'll give you my answer, which is we get a bunch of data and magic happens, and then reports show up. That's my version, which is clearly inaccurate, but maybe we'll talk a bit more here about interest rate risk modeling.
So we have our crystal ball and then we have our magic wand. So we're going to apply that magic wand, and we are going to take every moving piece of the balance sheet, the income statement, all of our loans, investments, deposits, borrowings, all of those moving pieces. And if you flip to the next slide, you can see that we're looking at this as a snapshot of that current balance sheet. So the very first thing that we have to do is make sure that we're capturing all these moving pieces, and so that in order for us to measure this. Now, before the financial crisis occurred, or like early on in the financial crisis, we were allowed to run ALM with growth assumptions embedded into the report, which for the most part, that was appropriate because many times we were incorporating expected budget numbers. So we were putting these numbers in, we were feeding and running this report to look at what happens based off of our budget movements. Well, during the financial crisis, this is the part where the art comes in from ALM. They're based off of the assumptions going into the report. We can make the output look any way we want to. And when we feed in extra loan growth because we have so many deposits coming in the door, we may be able to hide some risk that is actually there. So the regulatory guidance back in 2011 changed and said, you must start with a static balance sheet showing no growth at all. And this has actually been a nice exercise because it basically gives us a baseline look at where our balance sheet is. And when we say a no growth or a static balance sheet, the assumption here is if you have a term deposit and that is coming due, it's assumed to go right back on the balance sheet, the same term, the same type, just a new market rate. And at the end of that 12-month time frame, everything's assumed to just roll over. So assuming no changes are going to happen to our balance sheet over the next 12 months, let's take a look at where our risk may lie at the end of that time frame. And we like to do this baseline because that gives us a starting point of the conversation. And the great part with our model is we start off with this, but then we can also run what if scenarios, simulations. This is something that examiners love to see us do, this exercise of incorporating real world situations, real world movements or expectations. We can incorporate budget. We can incorporate a new loan program that we want to attempt to run, or, doing some investment swaps and restructuring the balance sheet. See that before and after impact of where do we stand as if nothing is going to change. We're going to sit on our hands and just let everything roll over, assuming everything's going to stay the same. But then do another snapshot of a real world situation or an opportunity that we may have to ensure that if these things occur, Is our risk in the right position to handle those things? And it's a great test to do for strategic planning and making sure that this thought process that we have is appropriate for us and that our balance sheet is in a position to handle it.
Yeah, it's a good point, Heather. I like how you frame that up. We need to run it with no changes just to see your risk, snapshot of risk. And then at least we should run a growth scenario with your budget to make sure everyone knows where the budget's going to come in, and we have that scenario. But it's interesting. And when you look, when we're running ALM reporting, we're always looking 12 months forward. And to me, that really becomes an interesting thing, because we're always looking at what happens to you over a 12-month time frame, which might seem a little funky when you get to March 31 reports, but but it's the right way to do it, so we can compare year to year, time period to time period.
And we know that rates are changing over time, and we know some of these replacements are going to be beneficial for us, especially on the deposit side. We know we had some higher interest rates years ago, and as those have come down, there's going to be some benefit of that turnover, but at the same time, you're going to see some benefits on the turnover of our loan portfolio and that investment portfolio now, as we've seen some rates start to rebound. And so as we're looking at that 12-month forward projection, as we had mentioned, all of our balances are going to stay the same, but we're going to assume that that new market rate is going to be implemented once that reprices and goes back on the books over that 12-month time period.
Yep. So, with that, I think moving to our next slide here is, how do we assess interest rate risk? What's the process we do, and how do we look at it? It's what we're going to get into here.
So these next couple pages is our starting point of understanding interest sensitive items, where they are today and where they can be in a year from now. So when you look at this page, we're looking at the asset side. We have our lending and our loan yields that go hand in hand here. And we do consistently look at historical trends and movements. But as we had talked about, we have to assume this static balance sheet over the next 12 months. So this is a great example as you see these historical numbers and movements that are continuing to happen over time. And we see from December of 21 in that top right corner is our current output. And we are showing a balance here that's going to stay flat over the next 12 months, $913 million. And that is going to assume to stay. And as that cash flow comes in, we were earning a 527, but now that expectation with those new market rates coming in is going to drop a little bit down to a 517. This is where we can utilize this information to identify some opportunities where we may look at some higher interest loans or look at some risk based lending, where are opportunities for our loans to try to sustain a higher yield long term. And then as we come down into the investment section, you can see both investments and our overnight funds. And we're doing a great job in the investment portfolio, really taking advantage of those repricing going a little bit higher. But one thing I really want to kind of focus in on is making sure we have the right amount of cash. We're only earning 12 basis points on our cash position versus 146 basis points we're currently earning on the investment portfolio, still assuming it's going to stay around about 140 basis points, even in a year from now. So making sure that we're keeping that cash going to work and maximizing what we can earn today versus waiting for putting a bet on the market that interest rates are going to rise, and then we would invest that cash to try to earn that higher yield.
Yeah, it's about 17% of the assets in this, or 15% of assets in cash. That's a big number, and it can be earning a lot more. But even we don't want to make a bet. We don't want to make a bet rates are rising or falling. So we want to make sure we're balanced correctly. And obviously here we're not seeing the whole picture of the duration of the investments, where you have a little snapshot of a picture here of a sample. But that'll make a difference in making sure we're correctly invested. Even if it's for a short period of time, we're going to earn more money than sitting in cash. We'll talk about buying 3 months, 6 months, 9 months, 1 year investments, and building a ladder that then you get to keep reinvesting those funds. And especially if rates do go higher, that's a smart way of doing it and taking advantage of it.
Yeah, and it helps balance that interest rate risk over time as you have that nice consistent ladder consistently rolling over and taking advantage of the market.
Yep.
So this next page is looking at the liability side. And again, we want to look at these historical trends and movements when we see certain spikes at certain times of the year. As we come into first quarter, this is usually the time of year where we see most of those funds coming in the door with tax returns, year-end bonuses, things of that sort. You usually see a large influx of cash coming in. And that's what we witnessed last year, on top of the additional stimulus packages and funds coming in this current market. But really monitoring and watching where these spikes and changes occur. But then also taking advantage of the opportunities of where we may see some, say, deposit migration. We're seeing that because of where interest rates are today, we're seeing a lot of movement coming from our term deposits moving into non-maturity. Even though we're seeing an assumed flat balance sheet, we're not actually incorporating any migration in that forward projection. Our balances are still staying flat. And if that does, we're going to see our expenses going from 86 basis points down to 69 basis points. Now we know that we're paying a lot less in these non-maturity deposits. So these are the conversations to look at and have of where are opportunities to be able to keep our expenses as low as possible and to maximize what we can on our assets.
Yeah, it's great. You can see that migration of yields lower as things keep repricing lower and everything, all deposits, but term deposits especially. And one of the unique things we're seeing across the board of all of our clients is that term deposits are shrinking. Consumers today don't want term deposits. They don't want CDs. We joke, ask a millennial what a CD is. Very few people under the age of 40 have a CD. And so I would expect that if you're really looking to grow deposits and you can't get them through checking, savings, money market type accounts, look at CDs, but also look at borrowings. It's going to be really interesting that you might end up backfilling with borrowings because of the lack of people looking for CDs. Well, now that we think a little bit about the structure, we have to talk about modeling and what regulators look at. And you talk about something called shocks, which I dislike inherently because I don't like shots or shocks. But shocks are an interesting thing that are important to talk about.
Right. So we start off with that science part or that accounting part. We've gone through, we've identified our loans, our investments, our yields, our deposits, all of those moving pieces. So now we're getting into the two most important moving pieces of risk measurement. And this first step is looking at net interest income. And what examiners are looking for is they like to do a shock test, meaning that everything is going to happen instantaneously, more of a worst case scenario, and what does that impact to our balance sheet? And so this is where examiners are focused on. This is what they're testing. And so we always start off with a shock test to appease examiners, but at least to have a high level look at where our risk is in regards to a parallel shock test. And when we say parallel, we mean that the yield curve is assumed to move in lockstep. Short-term rates, mid-term rates, long-term rates are all going to move at the same time for the same change as what the Fed decides to do for overnight rates. So if they decide to move rates 100 basis points, the entire yield curve is going to move simultaneously in lockstep 100 basis points. So that is our starting point of this conversation, is a static balance sheet and a parallel rate curve.
Yep, parallel change. And we'll talk more about gradual in a little bit for a little foreshadowing, which I like gradual, but we do need to look at shocks. It's extremely important. So really all of ALM, everything we've talked about here is really coming down to how we make money in the spread. And I use the word spread, the difference between our yield on our liabilities and yield on our assets, that difference there. But Heather, you call net interest income, which is the same thing.
It is essentially the same thing. This is just put into dollars versus put into a yield. So what we're doing is we take the income from assets. And when we focus on net interest income, we're only focusing on the interest sensitive products. So like we mentioned earlier, we're looking at our loans, our investments, and our overnight funds, anything that is tied to an interest rate. And to get to our net interest income, we need to bring in our expenses of our liabilities. What are we paying for our deposits? What are we paying for our borrowings? And then we get to our net interest income. And that's the starting point of our conversation for net interest income sensitivity. Over the next 12 months, what is that net interest income, assuming everything stays flat, no balance changes? the current interest rate, and then replacing with the current market rate. And at the end of that 12 months, that gives us our net interest income baseline starting point.
So as we're going to flip over to net interest income, I do have a couple quick questions I want to answer here. We're asked how often do you update ALM models for each institution, there's scenarios to make sure you have accurate assumptions loaded. So a couple things. Scenarios, we update our scenarios besides the plus minus 1, 2, 3, 4, 5 that we're running parallel interest rate changes. We also have 6 scenarios of interest rate twists and shifts. Short-term rising, long-term falling, whatever what the shifts are. Those are updated quarterly. Then also assumptions are something was a second part of this question, which we'll talk about here in a few slides. Assumptions need to be reviewed quarterly and make sure they're looked at carefully. So it is every time an ALM report's done, we need to look at that. And the other question that came in was talking about borrowing a minute ago. When we're talking about borrowings, it is instead of if we need to raise deposits, but we're not getting enough through CDs, or maybe the CD market we're in is too small and we don't want to have to raise rates super high in CDs, we can always compare to the Federal Home Loan Bank borrowing rates so we can bring money in. So instead of maybe rolling over a customer or member's CD, if we don't want to be competitive with the market or we think it's a hot money CD, we can always go and borrow instead. So a couple different ways to look at stuff. So sorry for that quick break there, Heather, but as we get into net interest income, it makes a lot of sense because all these assumptions have to be made prior to going into our report again, which we're going to go through the assumptions at the end, which is kind of fun.
Yeah. Yeah, and there's a lot of moving pieces that go into capturing the changes to each of these products in each rate scenario. And like Charlie had mentioned, later in this, we are going to be touching on assumptions. Today's a 101, so we're not going to get too deep on that, but at least a starting point understanding that we have to look at not just the balances and the interest rates, but how we're going to react to the market as well. So as we do these shock scenarios, we're looking at not just base case, but we're looking at every 100 basis point movement. If rates go up 100 basis points, 200, 300, 400, so on and so forth, what happens to our risk position in each of those scenarios? Are we able to reprice our loans at that same pace? Are we able to capture those new investments coming in the door? So our goal is to disclose our earnings sensitivity of our institution. How much sensitivity do we have if rates move 300 basis points? What does that net interest income look like at the end of that time frame?
Yeah, and so we're going to keep moving along here, make sure we get everything done on time. A lot of great stuff to talk about here. You've got a great picture here of how we look at interest rate risk.
Yeah, so this is coming from our summary report, and we're very large on trend analysis and really is. So we talked about net interest income and we're that base case. So our base case is our starting point of that 12-month forward projection. And as rates go upward, we know we're going to hold some risk if we have some duration because we have locked out, say, a mortgage loan or an auto loan. And over the next 12 months, we're probably still locked in at those interest rates. We have some cash flow coming in, repricing a little bit higher. But you can see in this scenario that our net interest income is going to decrease as rates go up. That's not necessarily a bad thing. We want to take on more risk. We want to keep that cash moving. We leave too much cash on the table, we're not going to be as profitable. So even though our sensitivity is somewhat negative here, our base case is starting at a higher point, and we're well within our policy limits, making sure that the policies have been established to be a proper amount of risk for our balance sheet and continuing to keep that money going to work. So looking at these trends, looking at these movements and comparing them to our policies, we're doing the right things here. We're keeping this cash invested, we're keeping the lending going, and we're maximizing our base case net interest income, holding a little bit of risk, but an appropriate amount of risk for our balance sheet.
Yeah, it's important. The trends are really neat to see. And then this is a shock analysis. We're immediately changing plus 1%, 2%, 3%, 4%, 5%. We call it basis points. 500 basis points is 5%. And then we're looking at this history at plus 300 or down 100. Really important. Those are some relatively normal terms. Heather likes shock because the regulators like shock. I like gradual because that's how I think about gradual. Here's a picture of a gradual rate change and what happens to income. And to think about this a little bit, a plus 100 gradual rate change, if we think about that, a plus 100 gradual change here, what does that mean? Well, that means that we're raising interest rates 25 basis points a quarter. So it goes up 1% a year. Plus 300 here, what does this mean? This means we're raising interest rates 25 basis points a month. So it's a constant change that takes place. So
You have
important.
you
Go ahead,
have the shock test, which is what we refer to as the examiner test, and then the gradual, which is more of a management tool. This is the likelihood that the market's going to change slow and steady over time. So this gives us a little bit better picture as a management approach of what our risk really looks like.
Yeah, this is net interest income, which is not the easiest thing to understand when it comes down to board members and people new at interest rate risk. So one of the other things we do is we provide a gradual rate change that goes down to net income. Here we can see net income. What happens to my net income? Well, here, this example of 17.5 million plus 300 goes down to 17.1 million, or down 2.4%. Not a significant change at all. And one would say that they probably wouldn't make 17 million today if it wasn't for this example, it wasn't for the amount of risk we took. So a lot of times when people new at ALM, to really break this all the way down to net income is a great way to understand what happens. And really, this is the most important thing. And we're wrapping up our first section of the two main tests here of net interest income. It's really important to understand how net interest income works.
So when we run these tests, at the end of it, as you're looking at the output of what your net interest income position looks like for your institution, you want to ask yourself a few questions and make sure that you're in a good place. What asset line items cause the greatest amount of fluctuation to your net interest income? Can you explain why that's happening? Do you know what we could do to smooth out that sensitivity if we're taking on too much risk? Are you comfortable with the results in all of these rate scenarios? So not only are you getting this output, but ask yourself these questions and go through these steps and make sure that you are comfortable, that you believe that this is reasonable. And if it's not, what steps do we have to do to be able to mitigate that risk?
And so thinking about this, what makes the biggest change to me? People are going to say it's a 30-year mortgage. Well, 30-year mortgages go off the 10-year treasury. And in this scenario, what we've seen from the last couple of years is they didn't go anywhere. The 10-year treasury unchanged. What actually has had the biggest price change has really been stuff in the 3 and 4 year time frame. And so it's not always what we think it is, and it really depends on the shape of the yield curve and how the yield curve changes. But we may have maybe one product, we have a lot more than other products that will cause that to be the highlighted product that causes the biggest change. And so it is product balance, product duration, a lot of things to think about there. So with that, we really wrapped up our first section of the risk measurements, net interest income, in our income stream, net income. How much money are we going to make if interest rates rise or fall or today? Because we don't want to lose money. We want to make sure we have enough money to pay everyone and keep the lights on and grow equity. And speaking of equity, net economic value of equity is the second important test we have. What can you share with us about NEV, Heather?
So NEV is the second piece of the two focus points of what asset liability management is what is our sensitivity to our income and what is the sensitivity to our value. So when we looked at net interest income, that is a forward 1-year projection. NEV, or net economic value of equity, is slightly different as this is a snapshot in time. Our most recent quarter output was December 31st. So when we look at our output and our balance sheet as of December 31st of 2021, what is the value of our balance sheet in the market? Essentially is valuing everything like a bond, the par value, the principal cash flow, our coupon rates, our maturities, or discounts. What kind of value does our balance sheet hold in the market as of that moment in time? So that's really that second piece, is what is the sensitivity of our income and what is the value of our balance sheet?
So we think about this, a lot of times one would think that it's going to be the longer term stuff that has the biggest value change, and you are correct. I love this graph Heather put together here, and what we're talking about here is really yield and price. And as we get things with a longer term and higher yields, but we get these bigger price changes that are going to happen at either ends of the curve. And so it's really important to think about this. And we have 2-year bond, a 5-year, 10-year, and a 20-year bond. And as you can see, a 20-year bond is going to have the biggest price difference. And so part of this risk is if you have a lot of long-term assets, they're not going to look good in a rising rate environment. But it's okay to have long-term assets. It's all about the balance. So the assets compared to the liabilities get us to what gives us a good balanced position. And this next page really is a neat outcome. This is the result of a NEIV report. And Heather, you walk everyone through this?
So when we look at this page and you look at value, really looking at, say, two different loan products that give you a nice picture of what that impact or change would look like. If we look at a 30-year mortgage, this is going to devalue, very similar to that 20-year bond line that you saw. As time goes on, that value significantly reduces because you're locked in at the current rate. And in each of these rate scenarios, you're not getting as much boost to that income position. But if we look at, say, a HELOC product, that's tied to the say it's tied to the prime rate and it reprices immediately. That value of a HELOC is going to hold on our balance sheet across the board in all these rate scenarios because it can move with the market. So understanding the different values that different products can have and what is going to add more risk. So making sure we're diversified enough where we can have long-term assets on our balance sheet, we can have midterm and short-term, that proper mix so that we've got a nice balance of what that overall look to the value of our balance sheet really is.
And here what we're looking at again is changes plus 1, 2, 3, 4, 5, and then the percent change in value. A lot of times we see people go negative, and the change means you have longer assets and liabilities, which is absolutely normal for our industry, and we want that. It means we're making a bit more money, and we want to take advantage of that. And here it's actually interesting. Plus 100, it's perfectly even, basically. You know, there's no effect to them, which is really neat. They're prepared. The sample is prepared for a rising interest rate environment. And you can see here we've been positive historically. We actually worked hard to this example to show someone that was improving their interest rate risk position by actually going a little bit negative, because that's going to put them in a better earning structure. That makes sense, Heather, what I said there?
Yeah, absolutely. Because you're going to taking on a little bit more risk for the benefit in the long term. We want to not be scared of taking on some risk because we are going to get that higher income, which is going to improve our bottom line, it's going to improve our capital and put us in a very good position.
As we hop through a couple more slides here before we wrap stuff up, NEIV exercise. I love this. I don't like exercise that often, but every now and then NEIV is good.
So the same applies for NEIV as it does with the net interest income. As we understand where our balance sheet is, where our position is, what asset line can cause that greatest amount of fluctuation? Do we have a good mix on our balance sheet, or is there something specific that's really causing that to tip too close to our policy or even outside of our policy? Can we explain why that's happening? And what changes do we need to make to bring us back to a healthy level? We want to be comfortable with these results. We want to make sure that we understand what's happening. And if there are some concerns and some changes that we need to implement, making sure that we are making the right decisions and using these tools to understand what that is, it really helps us be able to make proper decisions.
Well, and that's with making good decisions, is also understanding what examiners are looking for. We don't want to make decisions based off of that, but we want to make sure we know what examiners are looking for and that we can share that information. You still need to use your own balance sheet to make sure and make your own decisions on what's correct for ALM. But this is a big area of examiner focus to make sure that risk is being addressed. And this is where people have gotten in trouble back in the 80s and 2000s, with not having a good balance sheet, a well-diversified balance sheet. And so we want to make sure that if there is going to be a problem, we catch it early on. And that's one of the things you talk about, Heather. And all that results in some interesting trade-offs. And that's a fun one. And maybe you could help us with this a little bit.
So really looking at opportunities with, say, cash. We have a lot of cash coming in from deposits and stimulus, and we know that that can sit in our overnight funds. And earlier in this presentation, you saw that we were earning a whole 12 basis points. Now, when we look at net interest income, that makes our balance sheet very liquid, so we would be very positive in our sensitivity. Well, that could be a good thing, but at the same time, we're not earning as much as we could right now. So sometimes we want to take that trade-off where we're going to add risk to our balance sheet, but we're also going to add money to our bottom line. So that's where that balance coming in and that trade-off of adding risk, but also adding profitability.
Yeah, we've talked about balance from the first slide here, and balance and that margin and keeping the margin in place from earnings. And then we went to NEIV, and we talked about the balance of NEIV, having relative terms of duration of loans, investments, and deposits and borrowings, and that balance of the balance sheet. So as we move forward here, what do we do here? We need to understand the meaning of an ALM report. Really important things. And you crack up the first word makes me cringe, but policies. Where are we going with this, Heather?
So policies are one of those things that you have to be careful about just using the general template type of approach. You're not going to take somebody's policy from down the street and apply it to our balance sheet because that may not be appropriate. We want to make sure that the parameters we're putting into place aren't so wide that it's going to put us in a dangerous position. For example, when we allow our value to drop to a certain level, we want to make sure that we're still holding on to a proper capital position. We don't want to allow our balance sheet to take on so much risk that our capital disappears in the process. We want to make sure that the limits are appropriate for the structure of our balance sheet. And that varies significantly from one institution to another, just based off of that asset mix and rates, our liabilities, and what our market strategy is. Where are our opportunities? And that may be in a very different place than another institution down the street. And the policy limits go hand in hand with that.
And so thinking of this now, you've got your policy set, really important. You've got your ALM report, and then you need to use your ALM report. And what we're talking about now is using that report to think about, do I need to change the mix of my assets or rates, the mix of my liabilities or rates? What's my marketing strategy? Is my marketing department or marketing team or person doing what we need to change our balance sheet? And in the end, we need to review our results, make sure they're reasonable. Are they supportable? Does it make sense? And then what are we doing to change from our reports? And that's one of the big things here we work really hard on, is besides great reports, is really good actionable ideas to improve things. Well, now we're really wrapping stuff up. It's assumptions. Just a couple minutes here, Heather.
Yep.
Assumptions are absolutely the key component of ALM. And there are a ton of industry standard assumptions here. We could talk a little about some of those in prepays and core deposit studies.
Yeah, lots of assumptions go into the model and they need to be institution specific. A couple areas that is a high focus for examiners are our core deposit assumptions, which is the duration that we're assuming these deposits stay with our institution. And then also prepay speeds. How fast our loans are going to pay would be significantly different than another institution. So having those institution specific activities and reactions to the market really helps us hone in on having an appropriate risk capture because our prepays may be significantly faster or slower than a general market look at what those speeds could be, and also how long these the deposits stay with our institution. So this is a great example of a prepay study that was done, and you can see the significant difference from one type of product to another of how different those speeds are. Looking at an indirect versus direct, our direct autos are prepaying on a much faster pace than our indirect autos are. So being able to capture that and not assuming all autos are going to pay at that same pace, this is really going to give us a more fine-tuned look on risk measurement of our balance sheet that is specific to us.
Yeah, and speaking of specific to us, this is actually an example here where we showing here that this is saying that we've used someone's data to run their own prepayment speed. So really important. These prepay speeds take industry, but also your unique speeds based off of your unique area. With that, we've got to make a lot of assumptions in ALM. We have to look at loans. We've got to look at growth. How much are we going to grow loans? What's the replacement rate? If we're going to add a loan today, what's the new yield that we're going to put that loan on today? The betas. This is very important. If interest rates go up or down, what rate are we going to do? If we're putting car loans on the books at 4% today, if rates go up 100 basis points, is that 5 or 4.75 or 5.25? A lot of different options there. So we've got to make sure we're looking at those changes. And then as Heather just talked about, prepayment speeds, really, really important. In ALM, there's a ton of assumptions. For every asset type and liability type, we've got growth, replacement rates, betas, and then in assets, prepayment speeds. But we also have some prepayment speeds can be done in deposits. But as Heather brought up was the non-maturity deposit duration. Super important. That's something that if it's done wrong, it can really give you some bad advice. So it's really important to have good advice here. Also in borrowings, we've got to think about that too. How much are borrowing rates going to change? What's my replacement rate? What type of borrowings am I going to do? So with that, why don't you give us a good summation here, Heather, as we wrap up the presentation?
So I like these points that are listed. Don't think of ALM as a regulatory burden. This isn't just a requirement, but this is a fantastic tool for decision making. That holds a lot of valuable information and resources to see the impact of new products, assess whether we can take on more risk, stay ahead of potential problems. The entire purpose is to be able for us to be proactive, not reactive. We're looking in the future of where we could be. So we utilize this information to make proper decisions that is right for us.
Yeah. So with that, ALM is all about knowing where you are today, knowing where the potential are, but the potential where you can go, and how to manage your balance sheet appropriately and what changes to make along the way to get there. So with that, I'd like to thank everyone. We appreciate the time. It's the end of the hour here. We know people have previous commitments. We will be sending out information on our next presentation, which is actually going to be super exciting about our new online ALM system, and we'll get all that out to you. If you have any further questions, please feel free to reach out to Heather or myself. Hope everyone has a wonderful day, and think spring, it's heading in the right direction. Take care, everyone.
Thank you, everybody.
Thank you, Heather.
Thanks, Charlie.